Hey guys, Darren Sugiyama here, CEO and founder of Landsmark Capital, the most transparent premium financing intermediary firm in the life insurance industry. So today I'm going to talk about how to use a special form of premium finance life insurance as a hedge against risk that provides more certainty for generational wealth transfer and also unlocks capital for a client to invest in alternative investments or alt investments, as they're oftentimes referred to. So what are alt investments exactly? Well, it depends on who you ask. But the standard definition is that these are non-market correlated assets that can produce higher than market returns, but also come with a lot more risk as well. Things like private equity, venture capital funds, solar, renewable energy, digital assets, oil and gas, and the list goes on and on. But one of the biggest challenges that alt investment firms are having right now is that their clients are oftentimes afraid of risk. And so incorporating life insurance into the client's overall portfolio actually de-risks their allocations. And it allows the client to feel more comfortable venturing into some of these alt investments. So I built an algorithm that calculates just how much a client can comfortably reallocate towards these alt investments, without the fear of losing should the market crash. Now, essentially, I'm going to show you how to prove to your client from a mathematical perspective how they can take bigger risks, potentially get greater overall returns and have more certainty in their overall portfolio. And if you're wondering how I can do all of this, the answer is quite simple. I'm Asian, which means I'm genetically superior at math. So without further ado, let's go ahead and take a look at the real math. Okay, so we're going to talk about how you can show your client how they can increase their allocations towards alt investments by using life insurance as a hedge against overall risk. When we look at a traditional portfolio that doesn't have any alt investments in it, it will typically be somewhere around a 50-50 equity to bond ratio. Kind of conservative, not trying to get too aggressive, but not playing it too safe either. So 50-50 is kind of par for the course. And most people will use that 50-50 account to fund their lifestyle expenses once they get into retirement years. And at their end of life, that amount would be inherited by generation two. And if the client's net worth is above that estate tax threshold, generation two is going to get taxed at a rate of 40% on that traditional account's value. So alternatively, if you wanted to show the client something where they could get a little bit more adventurous, say kind of tippy toe into the waters of alt investments, which a lot of folks get really excited about, that could be very exciting for the client. However, one of the biggest concerns that clients have when looking at alt investments, again, things like private equity, venture capital funds, things like that, solar, energy, things like that, is that they could, in theory, lose it all, right? So there is a lot more risk, theoretically, with alt investments than more of a standard portfolio. So this is where we use life insurance as a hedge against that risk. So here's what it looks like. We're going to split this overall portfolio into two different buckets, a lifestyle bucket and then an alt investment bucket. The lifestyle bucket is just that. It's going to fund their lifestyle expenses or their living expenses through retirement. In this scenario, we're able to play it a lot safer and go with a 30-70 equity to bond ratio. Again, just to be a little bit more conservative and to protect against volatility. That lifestyle account is also going to fund the cost of the life insurance policy that will be placed in an irrevocable trust outside the client's taxable estate in most cases. We built an algorithm that basically can calculate, based on the client's living expenses, with cost of inflation built into that, plus the cost of putting the life insurance policy in place, just how much the client could reallocate towards alternative investments. So again, this algorithm, which I'll show you in just a second, is really key in terms of making a client more comfortable moving more of their liquid capital into alternative investments. And it's more fun too, right? They get to swing for the fences a little bit more. At end of life, generation two is obviously going to get taxed at 40% in estate taxes on that alt investment portfolio. However, the life insurance policy will pay out tax-free outside the client's taxable estate. So when we look at modeling this for a client, we do some pretty extensive back testing. If you've seen any of my webinars before, you know that we build a proxy for the insurance product, but then we also look at 121 different 40-year historical periods, and we measure historical S&P 500 returns, we measure 10-year T-bond returns, and it gets very, very extensive. So what we want to show a client is what assets perform better over different periods of time, when the market's up, when the market's down, different sequences of returns, et cetera, et cetera. So here's what it looks like. The first 40-year period that we analyze, out of those 121 different 40-year periods, starts on January 1st, 1970, and it rolls forward 40 years with an end date of December 31st, 2009. But then we said, what would happen if the client started just 1 month later? Let's say they started on February 1st, 1970. You roll the clock forward, that puts an end date, a 40-year end date at January 31st, 2010. And then so on and so on and so on. And so essentially, we analyze 121 different actual 40-year rolling periods, and we tag the 40-year period that produced the best compounded annual growth rate as well as the worst compound annual growth rate. And we see what different types of assets, how they would have performed during, again, the best 40-year period as well as the worst 40-year period. I always like to focus on the worst 40-year period. That's kind of the benchmark because, I don't know, in the spirit of being conservative, in the spirit of managing risk, if we benchmark the 40-year period that produced the worst compounded annual growth rate out of 121 different 40-year periods, I think that's a pretty solid conservative approach. So we're going to take a look at the traditional capital account. Again, this is without any alt investments. In this scenario here, again, this is the 50-50 account. So 50% in equities, 50% in bonds. In the pink section there, those are the historical S&P 500 returns. Again, starting on, in this case, we're starting on October 1st, 1971, and then rolling forward 40 years all the way up until 2010. And so those are the historical S&P 500 returns. In the blue section there, same time period, we are analyzing 10-year T-bond historical returns. And if we go up to the top there, we are going to assume that the client is living in California, household income AGI of $500,000, and that would put their top tier income tax bracket at 48.10%. And over there in the top right-hand corner, we're going to assume that their money manager is charging them 50 basis points as an advisor fee. So when we look at this, again, we're looking at best 40-year period, worst 40-year period. What would the final outcome be if they just stayed put in a traditional portfolio versus what would happen if we use life insurance as a hedge, we de-risk the overall portfolio in the lifestyle bucket, and then we get more adventurous in the, I guess we could call this an aspirational bucket, which would be the bucket of alt investments. So, okay, and we're going to start with a $10 million starting point. So $10 million of liquid AUM. And again, we're going to show how we can increase those allocations towards the alt investments. So we call this unlocking alt investment capital, which is a fancy way of saying we're showing the client how much they can move over and get more adventurous without risking losing it all in their overall portfolio. Again, these clients, most of them have a number in their head that they want to pass on to the next generation. And that's, again, where the life insurance policy provides more certainty in that aspect. So that allows the client to get more adventurous in their overall investment methodology. So let's take a look at how we're going to reallocate some of these funds towards the alt investment fund. I know there's a lot of numbers on the screen here, far too many to go through just on this webinar, but rest assured we have more data and back testing scenarios that you could shake a stick at. So if you ever want to really dig into this deep, happy to do so. Okay, so this is the lifestyle bucket. That lifestyle bucket is going to be more conservative than the 50-50 allocation. We're going to go 30% equities and 70% bonds. And what we're going to do here is factor in an annual drawdown amount to fund for the client's retirement. Again, this is just one of many income sources for a client of this net worth. And the goal here is to figure out, again, this is the worst 40-year period, we're going to figure out what it would take to draw down the account to zero at life expectancy. So this client, this hypothetical client, is age 50, and we're going to assume life expectancy is age 85. Again, just as an example. So we're factoring in how much we can draw down per year in retirement income to draw that account down to zero at life expectancy. And it also will calculate how much of the portfolio the client can move over towards alt investments. In this particular scenario here, the client can move over 19.66% of their overall portfolio to the alt investment fund. And that is during the worst 40-year period that we analyzed out of 121 different 40-year periods. In that yellow arrow there at the bottom in parentheses, you'll see that in the best 40-year period, the client could move over 35.79% of their overall portfolio to the bucket that has alt investments. Down at the bottom there, that's where we do the calculation. So again, 19.66% could be moved to alt investments during the worst 40-year period, and during the best 40-year period, the client could move 35.79% of their overall portfolio to alt investments. So here's how the algorithm works. We're going to input a life expectancy age. We're just going to use age 85 as a placeholder here. And what happens is it will highlight in black this cell right here, which is the ongoing account balance of this lifestyle bucket. It's going to fund their lifestyle expenses as well as the life insurance policy. We're going to also input a rate of inflation, and let's say let's use 3% as an example here. And what this does is it increases the client's annual drawdown amount by 3% compounded annually, again, to account for inflation. So here's where it gets really interesting here. What we're going to do is we're going to target the lifestyle bucket to be drawn down to zero. And this is during the worst 40-year period out of 121 different 40-year periods that we analyze. Again, the goal is to draw this account down to zero at life expectancy. And this is going to calculate how much of this conservative bucket, this lifestyle bucket, we can move over to something more exciting like alt investments, things like that. So let's go ahead and do the calculation here. And in this cell right here, it's going to show us just how much we can move over. As you see here now, the lifestyle bucket is drawn down to zero, and this calculates during the worst 40-year period out of 121 different periods analyzed, you could move over 19.66% of the client's overall portfolio to something more exciting, again, like alt investments. If we look at the best 40-year period, we could probably move over even more. So again, we're going to take life expectancy there at age 85. We're going to expect to draw that down to zero, and we're going to calculate. Bingo. So now we're at zero, and during the best 40-year period that we analyze, you could actually move over 35.79% of the client's portfolio over to, again, that more aspirational type of investment bucket, alt investment bucket. So this algorithm is really built to show a client just how much more adventurous they can get in their investing, because you're taking some chips off the table, you're putting it into a more conservative account that's going to fund their lifestyle expenses as well as the life insurance policy. We're increasing certainty with the life insurance policy to show them just how much is going to go to generation 2, void of estate taxes. And then 3, you can show them just how much more greater gains they can get, again, in that more aspirational investment bucket that might include alt investments. So let's talk about how we're going to use this premium finance life insurance policy as a hedge against risk to provide more certainty. And you see on the title, this title page here, it says Premium Finance Life Insurance Hybrid. This hybrid design de-risks the premium financed life insurance policy proposition even further. It eliminates the need for outside collateral. And as you know anything about premium financed life insurance, outside collateral can really be the Achilles heel of a premium finance life insurance arrangement. So I'll take you through this model here very quickly. Again, this is a 50-year-old. This is a survivorship policy. So both spouses are 50 years old. The annual premium is in column 1 right there, and it's kind of a funky premium schedule. This is a hybrid premium finance design we came up with. We call this third-year funding. And the way this works is in the first 2 years, the policy premium is $200,000. In years 3 through 10, the premium jumps up to $800,000. So the way the client funds this is in the first 2 years, they are paying non-finance premium, the full $200,000, and they continue to pay $200,000 in premium in years 3, 4, 5, 6, 7, 8, 9, and 10 as well. So 10 years of level funded $200,000 a year contributions. As we see there in column 3, the bank steps in and starts funding an additional $600,000 of that $800,000 in actual premium, and we are accruing the interest on those financed premiums. So the client is paying in $200,000 of the $800,000. The bank is paying in $600,000 of the $800,000. We are then accruing the interest. And the nice thing here is you see there in column 9, there is zero outside collateral required because we have those non-financed equity premiums entering the insurance contract in the first 2 years. On top of that, if you go down to the bottom of the screen here where my mouse is kind of moving around, we see that the client has contributed $2 million in premium. And in column 7 at the bottom here, we see that the client has only accrued $1.2 million in interest. So this is not an over-leveraged premium financing design. If anything, it is extremely conservative, and the client is actually contributing more than the interest that they're accruing. You may ask yourself the question, well, why would a client want to do that? And the answer is pretty simple. One is that a lot of clients, I should say, like the idea of setting a budget, in this case $200,000 a year, and they stick to that budget in years 1 through 10. The second reason that a lot of clients like it is now you're not screwing around with outside collateral and having to calculate it every year, or if something happens, the policy doesn't perform as expected, or the market tanks, or the collateral account loses value, all of a sudden they get a collateral call. And that's never a fun conversation to have with a client. So this type of premium finance hybrid design is one of 7 different premium finance loan models we have, and we work with 18 different banks on our platform. So every client's design is really tailor-made for their unique situation. Okay, moving on, we're going to pay off the loan in policy year 11. I know in a lot of premium financing designs you've probably seen before, they don't pay off the loan until you're 15 or sometimes even 20. In this scenario, we have found that the clients like getting in and out of that loan in a shorter window. So we're exiting the loan in year 11. Doesn't mean they have to. It just shows that they could if they wanted to eliminate that third-party debt sooner than later. In this design here, we see the policy hits a low point net death benefit, net of loans, at $8.4 million, and that's in year policy year 23. The clients would be age 72 at that point. And then if we go down to life expectancy at age 85, we see the net death benefit is $20.9 million. So nice hefty death benefit there. So this is what really gives the client, again, that certainty that they're going to pass on, if they pass at life expectancy, they're going to pass on $20 million to their heirs, tax-free, outside the taxable estate, which is really nice, plus whatever else they have left over. Maybe they might have some funds left over in the lifestyle bucket. Maybe they might have some funds left over in the alt investment bucket. The good news is they go to sleep at night knowing that if they pass away close to life expectancy, they're going to leave their heirs, roughly $20 million tax-free. Anything above and beyond that is all gravy. So that's what gets clients excited about being more adventurous and getting into alt investments, because it allows them, again, to swing for the fences a little bit harder without worrying that they're going to, if they go bust, that they're going to leave the next generation less wealthy than they were planning to. So here are the results of this methodology of unlocking alt investment capital. And again, a lot of numbers on the screen here. I'll make this easier. And happy to review this in person with you if you have a client that you want to do some joint work with. So in this column right here, that is the ongoing lifestyle allocation, or the lifestyle investment bucket. Again, we see we're intentionally drawing that down to 0 at life expectancy at age 85. If you follow my mouse right around there. Next column over, that is the alt investment bucket, where they get to be a little more adventurous. So they would also have that as an asset. They would also have the life insurance policy as an asset. And on the right-hand side of the screen, what we're looking at there, that is the worst 40-year period out of those 121 different periods we analyzed. And on the left-hand side of the screen, that's the best 40-year period. Let's stick to the worst 40-year period first, though. So the client would, on an ongoing basis, have and own the lifestyle bucket inside their taxable estate. They would own the alt investments inside their taxable estate. They would own the life insurance policy outside their taxable estate. And those values are the greater of the as illustrated death benefit and the accumulated value when we look at those back tested years, where we can kind of simulate a synthetic version of cash value in a real world product or a real world policy. So the client would own those 3 different assets there, add all those up, and that's that column right there. So that's the total of the lifestyle bucket, the alt investment bucket, and the life insurance policy. And then on the far right hand side of the screen there, those are the values if they keep all of the funds in that traditional portfolio. Huge disparity in outcome there. If you look at that on the right hand side, at life expectancy at age 85, using this new way to allocate more funds towards the alt investment bucket and incorporate a premium finance life insurance policy, Generation 2 would end up with a net $33.4 million versus only $6.8 million if they leave the money in the standard traditional investment portfolio. On the right-hand side of the screen there, this yellow arrow here, this is the best 40-year period, same measuring methodology. And we see that in the best 40-year period, it's a difference of between 38.7 million and only 10.7 million. So huge disparity in outcome. Here's a much easier way to look at the same thing. And again, we're going to take a look at age 85 there. That's the best 40-year period. 260% greater outcome using this methodology versus the traditional portfolio. And in the worst 40-year period on the right-hand side of the screen, 385% difference. It's a huge difference. The last thing I'll go over today is something that we will oftentimes show a client in terms of is life insurance a good place to create the liquidity that they're going to need at some point when they both pass away for Generation 2 to pay the estate taxes. And so I'll show you this. This has nothing to do with alt investments, but it has everything to do with showing a client the value of using life insurance to create this liquidity. So on the left-hand side of the screen there, that's that $200,000 annual contribution for 10 years. That's in the green there, that's the premium financed hybrid life insurance policy. And we see there, so $2 million total outlay. The net death benefit hits a low point at $8.4 million. That's at age 72. And then if we go over to the orange section there, that is the exact same life insurance product, non-financed. So in the non-financed solution there, we have the same $200,000 client contribution. However, the only thing that's going into the policy is the $200,000 of non-finance premium. Versus in the green section there, remember, starting in year 3 and going in years 3 through 8, the bank is paying an additional $600,000 in premium. So $800,000 in annual premium total in years 3 through 10. If we look down here again, a $2 million total net outlay, same outlay as the premium financed hybrid, but look at the death benefit net of loans at life expectancy at age 85. The premium financed hybrid has 20.9 million, whereas the non-financed life insurance product only has 14.1 million. And again, that's the same exact product, same carrier, same build, same everything, just a different premium allocation. Okay, one column over there. This is an equity and bonds portfolio, and this assumes the same 6.44% rate of return, gross rate of return, that we're illustrating in the policy. And we're assuming the investment manager is only charging them 50 basis points in advisor fees. This also incorporates a measly little capital gains tax rate of 33.1%, which is far less than most of your clients probably. And it also assumes the 40% in estate tax. So if we look again at those black cells there towards the bottom, that $200,000 annual contribution in a non-insurance based investment account after taxes is going to net $2.9 million at age 85 versus $14.1 million in the non-financed life insurance policy versus $20.9 million in the premium financed hybrid policy. If we go over one more column to the right, in column number 4, same $200,000 allocation for 10 years. And if we look down there at life expectancy, the question is what needs to happen in order to net Generation 2 the same $20.9 million as they would get in the premium financed hybrid design? And the answer to that is up top in the red box. They would have to get a 16.38% gross return in order to end up with the same $20.9 million at life expectancy. That is huge, right? That's almost 3 times the return needed in the life insurance policy. And then lastly, in the far right-hand column, we're going to show the same 6.44% return as we showed in both policies. And we're going to see what is it going to take to get to that same $20.9 million net at life expectancy. And the answer is, based on that same 6.44% return, the client would have to contribute $1.4 million per year for 10 years to come up with that same $20.9 million of liquidity at life expectancy. 1.4 million compared to only 200,000 in the premium financed life insurance hybrid. So when we look at the comparisons, I mean, I'm all about the comparisons, right? We want to look at mathematical comparisons, indisputable mathematical apples to apples comparisons. And that's really where the truth comes alive. If you want to take a look, or want us to take a look at a specific client that you have that either wants to move more money into alt investments or just get more adventurous in their investing methodology in general, this type of modeling can prove to be very powerful and very valuable, so your clients can see really the ultimate mathematical truth. Okay, so I hope you enjoyed today's webinar. And I'll say this, and I'll say it again and again, the more involved you get me in talking to your client in the early stages, the better chance that your client will move forward. They're going to have questions about all of this, the backtesting methodology, the philosophy of how much to move over to the alt investments, et cetera, et cetera. And the best part is any question they have, I have a mathematically sound, indisputable comparison model where they can see truly apples to apples. So in any case, I look forward to working on a case with you and showing your clients how they can get more adventurous in their investing without the fear of the risks that come with alternative investing. So I'm Darren Sugiyama, signing off. Hope you have a great rest of your day.